Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, December 7th, 2023. It's 9:43 a.m. Eastern Times. I'm starting the video, and what I wanted to do are share some trend lines that I have on the sectors of the S&P 500. I'll get to that one second. Trend lines I think could be significant, so I want to share those. I just kind of updated my charts today and set some alerts. And then I also want to talk on the email that I sent out today. There are some, I'm going to call them potential cross currents. Potential because they haven't happened yet. We're starting to see some signs of, like I said recently, that disconnect between the very strong positive correlation between stocks and bonds. But as far as the potential cross currents, that is what the post I got out to you today and the analysis I've given you in the last couple of days. You know, we hit, as I pointed out today, to the button, T3. Remember, we had T1 hit. We got a reaction there. T2 hit. We had a reaction. Stopped right at the bottom of that bounce target zone. T3 hit. Reaction as expected. Stocks were up this morning. Tick by tick with that. You can, I'll do it for you. Edit chart properties and put on QQQ. And, this is when Q's not trading in pre-market. You'd have to really do it with FXE. I'll do that. That's easier. You look at FXE, turn on the pre-market trades, and let's do that. Edit chart properties, show it. Okay, last two sessions. That's not working because FXE is so thin in after hours in the pre-market. So let me just turn that off. All right, you can see it clearly. Again, go back to EUR USD. And you can see the turn which came this morning. In other words, this is trading 24/7. There's the time right there. It pops up in the box, and you're trading this morning. Hit that level in the pre-market session. Crosshairs show me at let's see, 2 a.m., 3 a.m., 4 a.m., 5 a.m., 6 a.m. And so there we go this morning, and that's the concurrent lift right here. 8 a.m. and there's the 9 a.m. candle right there. And again, you could, I'd have to show it to you. Turn everything off here. Sometimes forget that I'm buried in this stuff. I'm watching charts in the morning and all that. Let me just turn off that comparison and we'll show you what happened today. Comparisons, turn that off. And then you can go to QQQ. And you can turn on a 1 minute chart, and then you can go like this, edit chart properties, and then show the pre-post data last two sessions. There it is. That is concurrent with the move in the euro right there, and that's that's over a 1% pop in the Qs right there, and it coincided nearly perfectly with, here we go, EUR USD. Again, this one's not showing after hours trades because it's trading around the clock. It already shows them kind of built in, but there it is. You can see it right there. There's your time of the day, 7:30, 8 o'clock, and that's that exact rally. So again, the correlation there is unmistakable and unbroken. However, we're going to talk on bonds real quick. So here's TLT, the 20 to 30 year bond. This was the trade we did because there was more juice. By juice, I mean longer duration. You're going to get more, from the recent rally on TLT. Was a total of 16, according to the pop-up box on the left, about 16.3%. And you could have went with less volatility, IEF, and the move was a total of 6.8%. Okay, so you've heard me say this before. It's one reason I don't typically trade GLD. I do trade futures or leverage. You got the juice built in, but if I'm going to trade, I'll trade the minors normally in lieu of, as far as the accounts that I use, ETFs mainly, accounts that I kind of wait for, use more futures. But so over the years, I've said it many times, I'll trade GDX as a proxy to gold. Because gold moves up in a multiplier, it goes up and down in a multiplier of GDX. I'm sorry. GDX, a little too much coffee today. GDX is the ETF for the gold miners, and it moves up in a multiplier. It's not a set formula, but let's say it's a good probably 2.0 in either direction. Go up twice what gold goes up in a bull trend. Sometimes more, quite a bit more actually. And then likewise, it cuts both ways. If you're going to short or get out, it'll go down more. And so my logic is simple. I'm either going to be right or wrong in a trade. Why tie up more capital than I need to? So therefore, if I'm going to be right, I'll go with GDX. And of course, I'll beta adjust my position size accordingly to account for the extra volatility, because if you're wrong, then you're magnifying your losses. And so that's the same thing. So I hope that makes sense, and that's why I picked TLT. And you can see that we did, almost 3 times what we would have done if, because we went out with more duration. So again, I would have been either right or wrong in the trade, and so we got paid a lot better. And then of course we magnified that, multiplied that gain on TLT by 2 because it was a 2-time beta adjust. All right, so that's that. Hopefully you understand my logic, my thought process. Now I watch all the bonds. I talk about the importance of the 10-year, but they tend to move together. Again, just TLT is going to go up and down more typically than IEF. Okay, so now where am I at? Okay, so right now we have those, what I call potential cross currents. I'm calling for a pullback in bonds. I am short Treasuries as of yesterday, and I think they will drop at best, as I mentioned this morning. I just want to clarify my thoughts. I expect a reaction, and I define this is, I didn't make up the term reaction, but as far as trading goes, I define a reaction as a pause and or reversal off whatever direction you're going. In other words, if you're going up, if something's in a bull trend, a reaction is either a sideways consolidation or a pullback. In other words, it's a correction, and it's one of two or a combination thereof. Sometimes you have just a mostly sideways, a little bit of a pullback. That's a reaction. That's a reaction. That's a reaction when you're going up. What's not a reaction is if you keep going, right? Hopefully that makes sense. So therefore, as I said this morning, and I just want to get these thoughts out, I think again, there are no guarantees, but best case, maybe Treasuries hold up here, and that would allow for the stock market to rally. But I don't think that's the case. I think Treasuries are going to go down. And I did point out, and we've seen, today's another great example, guys. Treasuries were down all day today. Let me just go to TLT, but you can see IEF in the red. TLT is down 0.051% right now, and it's actually gained a third of that since the open today. And yet, look at QQQ, very strong. At one point, I'm going to measure it up here, we were up 1.1%. Where am I going? There it is. There's that disconnect. I even turned on CNBC today just to hear what happens with the jobless claims at 8:30. And right after that, Steve Leisman was out there and saying what I said. He's now seeing just in the and again, he kind of almost mirrored my words. It's not a trend yet, but there is a clear observation that he made, that I made, that we've seen that disconnect between Treasuries and the stock market. It was a hyper strong correlation, and now it's actually this week been an inverse correlation, and today is yet another day of that. So that's something I've been looking for, and expecting, predicting. It's happening again. Maybe it reverts. Maybe this is just an anomaly this week. However, it is something to note. So, all right, where am I going with all it? What I said this morning, I maintain it'll be a combination of, and it could be one or the other. Let's just watch them all. In a perfect world, okay, if you are bullish, in a perfect world, you want to see this continue. You want to see Treasuries continue to rally, or at worst, maybe just consolidate and hold up here. That will help support the case for more upside in equities. Any downside, and again, I kind of, tried to put it in words today, it's, the magnitude and scope of the downside. Little downside isn't going to necessarily wreck the stock market, maybe return. But anything, like I said, if we come down to that target, I give you a pullback target yesterday of about 89.65 on TLT, which would be a, 6.5% drop. I can all but guarantee you that'll wake the stock market up and get its attention, and give us back, at least put some pressure on stocks, if not more or less. But again, it may not happen. These are things I lay out to look for, and then you can trade accordingly if you start to see it happen. There's like I pointed out, a minimum target I gave you. It's that uptrend line, and if you're a bull and you see that, maybe you say, hey, you know what, Treasuries, Randy, you're right. They come up too fast, but I think they're still going to go up in the coming weeks here. Then that's where you want to buy, and that's where you'd want to buy either stocks, because if that happens, you get that pullback, you'll probably see a little bit of weakness in stocks. But then if treasuries bounce, then stocks should bounce as well, because remember, that means yields, every tick up in this means yields down. It is, I've talked about this before, but I just want to say it for those of you new to this. I talk about these correlations and relationships, positive or inverse, between the euro, the US dollar, the stock market, bonds. There's one relationship that's immutable. It does not change, and it is tick by tick. And that is the interest rates, the yields on bonds moving inversely to their prices. And it's simply a function of that. There is doesn't matter what the credit quality is of US bonds, buying and selling pressure, that is one constant you're going to get. So it's not a on-off, more or less inverse relationship. It is a fixed relationship. Simple math, really, based on the yield of the bond and what the price is. All right, so keep that in mind. So therefore, watch this. I told you it's which way I think it's going. Now the cross currents I speak of are the euro. If we bounce to that, I give you a target, potential target up here, minimum target I've referred to it as. That's this downtrend line right here. It's a potential downtrend line. It's the same I gave it to you the other day as a maximum bounce target for off T2. I said we'd bounce, or I expected us to bounce anywhere from this level right here back to T1, which was that circled area, all the way up to that trend line. And so we had the minimum bounce target was hit. And so if that happens, that should be a net positive for the stock market. Again, just to put it on for you. And if you haven't seen it, comparisons, QQQ in purple there, and you can see the unmistakable correlation. And even so, you've seen extra weakness. You've seen a little bit of separation there as well, just in the last couple of days. This is just since a couple of days ago. You see QQQ kind of going sideways here and ignoring that drop in the euro. I think it's anticipating the euro is going to do this. And what you're going to get is a mean reversion to one degree or another, meaning either QQQ comes down or this goes up, or a little bit of both. We'll see. But I will say, if this happens, let me just be clear here. There's a lot of variables here, not too many. We're talking 3 securities, the big 3 that I talk about. The Forex here, the euro, the US dollar, bonds, right, particularly treasuries, and the stock market. And so this would be bullish, net bullish for equities, as would be a concurrent rally in bond prices that I just talked about. In other words, we don't get that pullback in TLT and IEF. And that should be net bullish for equities. Anything else, you want to see something really ugly, let's see this little bounce off support here, my third target, get faded and take out T3. Remember, I told you there are additional downside potential targets here. So let me turn off that comparison, jump back out to the daily, and then I'll get to those next charts I want to talk about. So this is a line I told you I still think has a decent chance of being hit. If it does, that will almost certainly, most likely, take stocks down if we have more downside here in the euro. So that's it, guys. It's kind of, I don't have strong convictions because of everything I just mentioned right now, all these cross currents. It looks like the euro's probably going to bounce a little more. But if it doesn't, then react to it, especially if it takes out today's lows, which was that support level it hit, the target, and bounce. All right, let me show you a few more things. And we're going to look at the sectors of the S&P 500. So here's the S&P 500. And as I mentioned, any new high soon, you're going to have, if we happen to get it in the regular S&P, which again is top heavy with the Mag 7, any new high equal. All it has to do, and we're almost there. Look, you want to split hairs, you can say we already have a divergent high here, an even bigger divergent high. I'm just duplicating that. So that's what negative divergence is. All you have to have is an equal or higher high in prices if the indicators are making lower highs, right? And so, effectively we're almost there. As I've covered many times recently, the equal weighteds are well below those previous July highs right there. It's just, this is all almost exclusively due to the overweighting of the Mag 7, and not just their overweighting, but their overperformance over the rest of the market. All right, here's what I wanted to show you. So let's put up. I'm going to leave these here, and then I'll go over the PPO crossovers in a minute. So we're pending. I don't know if we got it yet. Let me just see here. Yeah, we did. We have that daily PPO crossover. I've covered this a lot lately. And if you're just catching up, maybe go back to one of the recent market videos. I look for these big green hills, especially up to this purple line right here. And then you look for those, I call them hills, they're histogram, PPO histogram. And then I look for the crossovers, and they identify, they're pretty accurate in identifying major trend change, inflection points. You can see one there, you can see one there after that rally, and again, follow what the market did after that. And so we just got one the other day. So they are sell signals. Like I said, I'm not waffling. A sell signal is a sell signal. They're not exact timing indicators, but they are worth noting. Okay, let me put the histogram back here and just wrap this up. So there are, again, a total of 11 sectors in the S&P 500, and you've probably heard me say this before. An index or a sector is simply a sum of its parts. That's the simplistic view. For example, the RSP, equal weighted 500, is simply a sum of its parts. There's roughly 500 companies in the S&P 500. And if you add up all those companies, that's gives you what the index is and what it's doing. However, in the real world, it's a little bit more complex because when you look at QQQ and the NASDAQ 100 or the S&P 500, it's not simply a sum of those parts. It's a weighted sum with a much heavier weightings on the top component because it's a market cap weighted index. And then you have companies like Apple at $3 trillion that dwarf the bottom 400 companies in the S&P 500, and even dwarfs the bottom 480 companies. So that's kind of why. All right, so hopefully that makes sense to you. However, it is a good, if you want to get a kind of a comprehensive look at the market, then you want to look at all 11 sectors, and you also want to pay attention to those sectors' weightings, because even then, it's not a sum of those 11 sectors. They also have different weightings. We're going to go over that right now. But there it is. And this is a common theme here. While I'm on the RSP, the equal weighted S&P 500, this is it. So what I've done, and I didn't do it on RSP, but I will right now. I've set alerts, price alerts, on all these trend lines. They may or may not be the catalyst for the next decent correction where the markets start moving lower and continue lower. Right now, we've just kind of been flopping around, grinding a little slightly sideways to down over the last week or so. But this could be it. So anyways, I want to share these levels. I would suggest replicating them on your charts and having the same thing. So there's one on RSP, and I'm going to go back to SPY so I can load the components here. SPY, again, telling a little bit different story than RSP, but here's the sectors of the S&P 500 in order of market cap. So I haven't updated this since the end of, it's been almost a year now. I did it last, I do it every so often. I did it on December 30th of 2022. I don't know if you can see it there. I'll read it out. It says 25.74% weighting. So it's not changed too much. Tech, in recent years, it used to be energy was a big sector, and even financials, decades ago. Now it's tech is everything. We know that. And so the weighting is still roughly a quarter. So think about that. Out of 11 sectors in the S&P 500, the top sector accounts for over a fourth of the returns. And again, that's you got your Apple in there and Alphabet and those things like that. And there it is right there. Again, this was what I did back on December 30th. Microsoft alone was 22% of this sector, XLK, this sector ETF, the tech sector. Apple was 22%. So 44, those two stocks alone make up half of the tech sector ETF. Okay, so here it is. Look at the line. So this is what I wanted to highlight for you, and then I'll just wrap the video up showing the PPO crossover status on all these. We have 1, 2, 3, 4 candlesticks there, so nice clean line started there, and it picks up here. I will say I'm not super crazy about this trend line because I like to see three areas, even if those are four reactions, but they're all right next to each other. I'd prefer to have seen another reaction point along the way. But it does meet the criteria of a trend line. You can, again, draw off those candles. And, I'm not putting a super heavy weighting on all these lines, but I am putting price alerts, because if they all get taken out and I start to see impulsive selling afterwards, then that will help tell me that those were technically significant. So there it is, XLK, the largest sector, probably the most important one to go. And then also, just like QQQ, you still have this massive island up here. I don't know if it's getting long in the tooth, but, would still be an island if we had a big gap down. It'd have to be, I mentioned that somebody asked about an island reversal on something the other day. Was I think it was natural gas or something. I said, no, if you have to squint to see it, it needs to be obvious. So if you have to squint, don't put too much into it. But if you get a big old gap down that leaves this island of candles here, that would be a potential sell signal, especially in conjunction with everything else we've seen, such as the recent bearish PPO crossover, the trend line break, et cetera, et cetera. So there is no sell signal, zero, not even remotely close that I see right now on XLK. I do see, I just pointed out a few potential things that could give us one, including and not limited to that trend line break there. Next up is XLV. This is the healthcare sector. Healthcare sector has been dead money. I'm just scrolling back and you can see this is going back into early 2021. We've been in this just massive trading range. And if you remember, a lot of people aren't realizing, say, it's okay, I'm in my 401k, it's not going up, it's not going down. You actually lost money if it's for real returns. And, if you adjust in for inflation, we've had hyperinflation the last couple of years. And so your purchasing power is down. So remember, this is in, this is the actual index. But again, it is what it is. Now, from a technical perspective, that is either a massive topping pattern there, kind of like a base but in reverse, or it could be massive high-level consolidation, and then this happens. Bulls want to see it. Bottom line, if we can get way above this, break out above this, all those previous highs right there, and run about 142, unless it fails, that's super bullish, because I always talk about these patterns. The bigger they are, when you get these sideways trading ranges, they're pretty well defined. Especially the bigger they are, it's like a coiled spring building energy. So, look out below if this breaks to the downside. There it is on a weekly chart. Probably spending too much time on that because my point was just to kind of focus on the near term. I know I do a lot of macro big picture stuff. I sing the bearish song and how I think this market's got a lot of downside in next year in 2024 and 2025, maybe, and probably beyond, with some massive big bull market rallies or counter trend rallies along the way that hopefully will catch, and maybe not. But you can't completely position for that now because that may not happen. But so I'll talk about the big picture, where I think things are going, lay out targets if it begins to happen. But in the near term, this is what needs to, in my opinion, determine your positioning. We have this uptrend line here. So now I'm on sector number 2. Again, I'm going through in the order of the market cap. Again, little dated. I'll update this soon, but there's about a 15.82% weighting in the S&P 500. And so certainly significant, right behind XLK. There's the trend line. It's pretty well defined, not super well defined. Here's where I have it. I allowed one little candlestick shadow to pierce it down there, right there, the tail of that candle. But I have enough reactions and it's on it. And that's actually, you have like more reactions here. 1, 2, 3, 4, 5, 6, 7, and now we're on it again. I have a price alert on this. I have a price alert on all of these trend lines, the ones that haven't yet been broken. So I just showed you 2 so far. And, when I look at things like this, the more of these sectors that I see that have pretty well-defined trend lines, the better the odds are that those trend lines are going to be significant if and when broken. So that's the takeaway here. And, okay, that's number 2. And then, I'm not going over every little nitty-gritty thing in the chart. There's also some resistance here we're at and other things. I'll get to the PPOs in a second. Sector number 3 by market cap or weighting in the S&P is the financials, about a 12%, 11.68 as of the last time I checked, almost a year ago. And the best trend line I can draw on that one has already been broken. So I come off the lows. That's just, and you can see the slope of these trend lines are all about equal. This is all due to the move in rates. Remember, we were expecting that. And as I said, that kind of, a couple days after when I started, I was long the initial part, and then I started getting out short, and then I posted you guys on like, what am I doing here? Because I'm uber bullish on bonds, and there's no way, I said it's very unlikely to see stocks go down until bonds. So then I kind of backed off my, aggressiveness, and should have just jumped back in, and I didn't, but that's whatever. Like I said, nobody bats 1,000, but that's where we are now, is this trend line. Again, I'm not super crazy about it, but I would say the best fit is this right about here. And so you have the initial reactions, couple candles there, and you broke it, and then you're back testing from below. So that one, if you want, you could certainly do this, but I'm just leaving that one like that. Again, you want to play it safe. Just put a trend line under from the lows to these recent lows, but it's just not. There's not a lot of. There's more reactions on this one. That's why I had it like that. Okay, that's sector number 3. Sector number 4, XLY. This is consumer discretionary. For those of you not familiar with the terminology, there's on the consumer side you have 2 sectors: consumer staples and consumer discretionary. I define consumer staples as things we need, toilet paper and deodorant and things like that, that you go to the store and you're going to buy no matter how bad things get. Consumer discretionary are things we want, big screen TVs and the likes, so Nike Air Jordans and all that good stuff instead of cheap flip-flops or whatever. Anyways, you get it. So there's the holdings right there. It's about, again, as of last December, 9.8% weighting, sector number 4. So, close to financials. Amazon makes up a quarter of that. Again, back then, Tesla, 10.5%, Home Depot, and then Nike rounding out. So you can see just those alone right there is half the sector. So this is a common theme in not just the stock market, but many of these sectors. Uptrend line, pretty well defined, broke, but with the broad market not rolling over, those sectors that have already broken that trend line, again, if it's valid, we're drifting back up. And sometimes that happens. Sometimes you break a trend line and you never look back. That's a sell signal. Sometimes you break one, you go up and back test or have a little kickback rally, and then you roll over. We also have downtrend line resistance. So that one's already been broke. I don't have an alert set because we're already below it. XLI, industrials. Again, I can draw a pretty clean trend line. A lot of reactions here, coming up here, broke down, and a high level back test right there. So, it's valid enough because you had another reaction off the back test. And we'll see. XLC. Communications, it had a pretty clean trend line. I think that was well defined. Let me tighten it up a little bit. When I say tighten it up, I'm, sometimes I'll draw these kind of rough, and then you zoom in, you can really come in and touch as many candlestick bodies. That's how I draw a trend line: bodies and or wicks, the skinny part. And in this case, you have a lot of reactions on there. You have a breakdown, and it's been moving lower. So that one's on the sell signal. So quite a few have already broken down, and then those that haven't, I have alerts on. And so if you get, let's say 7 or 8 out of the 11 sectors of the S&P, especially the bigger ones, that's, again, tech and healthcare. That's important. So XLP, pretty well-defined trend line. We're right on it. And then XLE, this one's been in a downtrend, so there's no uptrend line to draw. You do have some positive divergence. I told you crude and nat gas look like they're getting a lot closer to bottoms than anything. Anyway, so I don't have a trend line on that one. Energy doesn't move the needle as much as it used to. Last I checked, it was only a 5.23% weighting in the S&P 500. And of that, it's almost all ExxonMobil and Chevron. They make up almost half of the energy sector of XLE, at least this ETF. XLU, utilities, remember you're getting down where they don't move the needle as much. It's not as much importance to the market, 3.17% weighting, but just a beautiful clean uptrend line. You can see it there in which to trigger a sell signal. These guys are very rate sensitive, meaning when interest rates go down, as they have recently, the utility stocks will rally, and vice versa. A lot like REITs. XLB, basic materials, the best trend line I can draw. We're well above it right now. A lot of reactions here, and so that one's a little more healthy. And I like, I'm kind of, me, more of a commodities bull right now than anything longer term. And, I think basic materials is a sector that's probably going to outperform the market in the coming years. But either way, we're still comfortably above that trend line. And then there's XLRE, the REIT sector ETF. And there it is right there. Let me tighten those lines up, come in, capture all these candles as best I can. You can see it starts out here with the candle off the October 30th low. Then that candle there, that one there, that one there. So I have an alert set there as well. So there it is. We're above trend on the majority. That's the takeaway. And now we're just going to bring this thing home by doing this. We're going to park these two indicators down here, put up the PPO histogram. I already showed you on QQQ. We recently got that, bearish PPO crossover for the first time in a while. SPY, I showed you that's in effect now as of the other day, and now we're going to run through those 11 sectors in the S&P 500. XLK Tech, we had it, and it's still in play. And again, let me turn off all the lines above and just show you, these are the big green hills. This is when the bear market started back here, and let's just look at a few of the big hills when you had crossovers. You had a couple whipsaws here. Then the crossover finally stuck right there at the top. But we were kind of stalling out, and we did have corrections on both of them when we got those crossovers. There were corrections. Then the big one came, and that was after this hill. We had a red crossover there after a little hill downside. Big green hill right there. We caught that rally, and then we got short again. That was a bearish PPO crossover, and you got that huge drop there. You had another big green hill. Then a drop. Wasn't a lot left in there on that drop, but either way, another big green hill. And again, you look at not each and every, you look at collectively. More often than not, it works, and more often than not, it got you in short and kept you short. It stayed red throughout the biggest drops in the bear. A couple big green hills, crossover right here, and then boom, that big green hill, crossover here, and then that. Not that big of a green hill really, but there was still a drop. Decent hill, nothing huge, and really this one, it didn't pan out for much. I'll say that, so we'll call that a, no sale. But then look, and you had another so that basically had a whipsaw right there. But then the next crossover got it, boom, nailed it. Green hill, PPO crossover, boom. Green hill, PPO crossover, boom, and there it is. So this one hasn't yet played out. I think it will. And I think it can play out because, again, I'm looking for a potential end to a bear market rally here, which may already be in play. Remember, we're at its top. Let's not forget. And the majority of stocks, all the equal weighted indexes, all the, the very balanced ETF like VTI, which has small, mid, large caps. As I've mentioned, one of the best ETFs out there due to the index it tracks, which is a compilation of all of the stocks in the U.S., and that's VTI and or the Wilshire 5000. So they've all topped. Okay, back to my sectors. So there it is. I just want to click them off. Let me just finish this and get the video out to you. XLV healthcare holding up. No imminent unless it drops hard. It's pretty healthy, but you have big green hill, and it's just again something to watch because it's the second largest sector. There was the last crossover from a big green hill right there. You got that. You had a little whipsaw, and if you just followed it religiously, I mean, seriously, if you just followed these religiously, and then were long when it was red, long when it was green, and short when it was red. Look, you would have got all of these. And if you're in a bear market, you really want to look for the bearish cross and I'll tell you what, and the bullish crossovers. We have, again, we didn't miss a single bear market rally since the bear market started in the top of 2022, nor did we miss out on any of the downdrafts. We didn't, sometimes I got on a little early, got in a little early, got out a little early, but we caught most of those inflection points, and that's what I'm looking for. That's what I try to do: time tops and bottoms. There is a massive green hill. There is your bearish PPO crossover. It said sell your healthcare stocks or get short if you are a flexible trader. Here it said get out of your shorts, get long. I mean, come on, guys. This is track record is pretty damn good. And the problem is when I say this, I don't want to oversell you on it, because then every now and then, just when an indicator is working really well, is when the dang thing stops working. So you can't put everything into it. Sometimes you get these red crossovers, you get the signals, and then I showed you a few whipsaws, and then boom. So again, you take it in conjunction with everything else. What's everything else? One of those everything else is the trend lines I just showed you. You get those breaking down. You get other sell signals. Then it just builds a case to be short. Okay, so that's sector number 2. No PPO crossover yet, and really not at risk at this point in time. Financials, sector number 3. Absolutely getting close. We're, what I refer to as one bad day away. It doesn't guarantee if we are down tomorrow. I'm saying a really bad day, 2-3% down day in the financials probably do the trick. Or remember the way these momentum indicators work. PPO is a momentum indicator. We're not going down. We've been going up. But what happens when you're going up very strong and fast, and you start going sideways? Well, that's a change in momentum. It's just like, physics. You throw a ball up in the air, it's going up, 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 but then the rate of ascent is slowing. So the momentum is slowing, and it even sits there suspended, not going up or down for, a split millisecond. And that's what's happening here. It's showing you that the momentum is waning. So for those that say, don't fight it, we're in an uptrend, this is saying, yeah, you're in an uptrend, but that uptrend is probably about to end. And again, you can anticipate these crossovers, and if you just trade them, and again, it's not a standalone buy and deal sell signal, but you probably, and you want to back test it. For those of you that want to run, all those trading platforms now have those models. You can back test things like this, but I use it in conjunction with everything else. Other timing indicators and trend line support resistance, divergences, overbought, oversold readings, 60-minute charts, other buy and sell signals, moving averages. There's an infinite number of other things there. But again, I'm just pointing out the track record of these. There's a little one. Avoid these little hills, these little whipsaws. But still, I just said get back in after that little pullback there, and you would have juice that rally. You got in there on the green candle, you would have juiced this whole rally. You'd still be long just based solely off this one indicator. Look at that beauty right there. Imagine if you heated that bearish crossover right here and sold out of your financials and then turned around and shorted them. You would have just been killing it. So all right, guys, anyways, close but not there yet. But again, it looks imminent to me. Looks like it's right around the corner. I wish we weren't rolling into the Christmas season. It tends to be. Everyone's off vacation. Things don't. Sometimes you'll get a surprise move, but the history is typically you tend to drift up the last couple of weeks into the end of the year. But we'll watch this. This is why I do this every day. I'll never take my off the ball. Just when you think sometimes nothing's going to happen, it makes me think of the Tet Offensive in Vietnam. That was, one of the most successful military campaigns that the North Vietnamese had against the Americans. They, we figured it was Tet, the Chinese New Year. They're just going to be partying and having fun. So our guard was down, and they hit us. They hit us hard around the country, and did some pretty big damage. And so I kind of use that equation that never let your guard down. This thing can come out of nowhere. It's probably not going to happen over the next few weeks, a big drop. But if it does, if I start getting price alerts, and see, I don't even have to be in front of my computer. I get these alerts. When they trigger here, I get an email. I can get set text notifications, and then boom, I can run and jump in front of the computer. If all of a sudden, the majority of those trend lines start breaking, then I'll look and see what's going on. All right, so XLY, consumer discretionary, sector number 4, getting close. Not there yet, but certainly getting close. Something I'm watching for. XLI, stronger, than looks like healthcare. It's not at any risk of an imminent crossover right now. But again, it'll be a check mark if and when that happens, if the others are all red. So let's see if we can whittle our way down here. XLC, it's on a sell signal, already crossed over. XLP, 0.01, one bad day from here, and it's going to give a crossover. And remember, you got to wait for the daily close. If we're turned around and we were red today, it's going to turn red, and then if we close the day green, it's going to print a green close. This is a daily chart. All that matters are the daily closes there. So the takeaway is, as I go through these, and I'm getting down to the sectors that matter less. There's one bearish happened yesterday in energy sector, and it's still red today, so we have one there. Not yet in XLU, and again, these smaller ones don't move the needle as much, but there it is. We do have one right there in XLB today, but today's not over. And then XLRE. So the big ones there, XLK, you have it, and I put a big weighting on that. XLF, close but no cigar yet. XLY, close but no cigar yet. Okay, so when these start to roll over, and it could happen quick, guys, or it could happen slow. It could be a slow roll. So far, it's been a very, I don't even call it a slow roll yet, because we haven't really rolled over the market, if you look at the regular weighted indexes. It's just kind of slowing down. And we can all see what we want to see, say what we want to say. Maybe this is a roll, we are rolling over. I think we are. But maybe we're just consolidating to work off the overbought conditions before the market has another punch up. If this happens, I would put a very high degree of confidence it's going to be because Treasuries just power through those divergences and keep rallying, and rates keep coming down, and there's no blow-ups in the financial system, and maybe the euro, that positive divergence I showed you on the 60-minute chart of the euro earlier today, that starts to play out, and we see the euro rallying and the dollar falling. Those are all things that would be bullish for stocks, and if it goes the other way, that's going to be bearish. Okay, but that's it. I gave you the things to watch. That's what I do here. So, I tell you where I think things are going, but I also tell you what's going to ruin that or make that probably not happen, or things that will help seal it up and firm up my case where we're going. In this case, it's just simply those trend lines I gave you earlier, and more or less and less of these bearish PPO crossovers. All right, guys, I'm going to wrap it up here, get it out to you. This has been Randy Finney with Right Side of the Chart. Have a great day.